All right, so let's dive into Bitcoin halving strategies. It always gets the crypto world buzzing, right?
Definitely. Yeah.
Now, we know you're already familiar with the basics of Bitcoin, but today we're going deep into the strategies surrounding this halving, particularly this intriguing 500-day strategy. Is it all hype, or there's something more there?
Right.
We've got research analysis and expert opinions all stacked up here ready to unpack. We're on a mission to figure out what's real and what's risky, especially for anyone considering buying Bitcoin 500 days before the halving. And of course, the big question, when do you sell?
Well, what's fascinating about these halving events is that they inject this sense of anticipation into the market. It's like a shot of adrenaline, sparking all sorts of what-if scenarios.
I'll admit I'm a little skeptical of this 500-day strategy. On the surface, it sounds almost too good to be true. Buy low, ride the hype wave, sell high. But how does that actually play out in a market as unpredictable as crypto?
Well, the strategy is grounded in this fundamental principle of supply and demand. With each halving, the rate at which new Bitcoins are created is cut in half. This creates a supply shock, which historically has driven prices up.
Okay, so let's talk about that historical precedent. We've seen some pretty dramatic price surges after past halvings. In 2012, Bitcoin went from around $12 to over $1,000. Then in 2016, it jumped from about $650 to nearly $20,000 by the end of 2017. It's pretty compelling.
It is, but it's important to remember that past performance is never a guarantee of future results. The crypto market is notoriously volatile, and there are so many factors at play. What we can say is that the halving events certainly seem to act as a catalyst for price movements.
Right, and it's not just the actual reduction in supply, it's the perception of scarcity that fuels the hype too. Every halving gets amplified by the media, attracting new investors and further boosting demand.
Exactly. It becomes a bit of a self-fulfilling prophecy. This leads us to the 500-day strategy. The idea is to buy Bitcoin 500 days before the halving and sell 500 days after. This time frame isn't random. It's based on analyzing historical price trends and pinpointing a window where Bitcoin has shown significant gains leading up to and following a halving event.
The ideal buy-in date, according to this strategy, would have been December 6, 2022, and the potential sell date would be September 2nd, 2025. But wouldn't the increasing awareness of this strategy itself impact its effectiveness? It's almost like everyone's trying to get in on the same secret.
That's a really good point. The more people who jump on the bandwagon, the more potential there is for the strategy to become less effective. This is where understanding technical indicators and market sentiment becomes crucial.
Our sources highlight a number of those technical indicators, like RSI, the Pi cycle, the Fear and Greed Index, even the rainbow chart and Ichimoku cloud. It's a lot to take in. So how do we make sense of all these indicators? Can we even rely on them in such a volatile market?
You're right. There's a whole arsenal of tools out there, each offering a different perspective. The key is to not rely on just one indicator, but to combine multiple indicators to paint a more holistic picture of the market.
So it's like gathering evidence. The more clues you have, the stronger your case becomes.
Precisely. For example, the RSI, or Relative Strength Index, helps identify overbought or oversold conditions. It can be a good gauge for understanding if the current price is sustainable or if there's a potential for a correction.
So if the RSI is screaming high, that could be a signal that things are getting a little too heated and a price drop might be coming. But how reliable is RSI in a market as volatile as crypto? Are there cases where it might give false signals?
There's always that possibility. No indicator is perfect, and that's why it's so important to use multiple indicators in conjunction with each other.
Okay, that makes sense. So we've got RSI, which can give us a sense of market momentum. What about some of these other indicators like the Pi cycle? Our sources mention it as a tool for pinpointing potential market peaks.
Right, the Pi cycle uses specific moving averages to try and identify those peaks. The Fear and Greed Index, on the other hand, gives us a snapshot of overall market sentiment. It basically tells us whether people are feeling overly optimistic or fearful, which can have a big impact on buying and selling behavior.
So it's not just about charts and numbers. It's about understanding the psychology of the market, too. And what about these more visually driven indicators like the rainbow chart? It sounds pretty straightforward, but I'm wondering how accurate it actually is.
Well, the rainbow chart uses a logarithmic regression to map Bitcoin's price history and then visually represent potential buy and sell zones. It's a way to get a big picture perspective on price action.
That's interesting. And then we have the Ichimoku cloud, which sounds a bit more complex. How does that one fit into all of this?
The Ichimoku cloud uses multiple lines to identify support and resistance levels, potential trend reversals, and even future price direction. It's a more comprehensive tool, but it also requires a bit more expertise to interpret effectively.
Okay, so we've got this toolbox of indicators. but knowing how and when to use them is key. And I'm guessing backtesting is a crucial part of that process, right?
Absolutely. Backtesting allows us to test these indicators against historical data to see how they would have performed in the past. It's a way to evaluate their effectiveness, fine-tune our strategies, and ultimately make more informed decisions.
So it's not about trying to predict the future, but about learning from the past and using that knowledge to navigate the present. But all of this focuses on market timing right. What about choosing the right assets in the first place? Our sources also emphasize the importance of understanding the fundamentals behind a cryptocurrency.
That's absolutely critical. We can't just get caught up in the hype and speculation. We need to understand the underlying technology, the team behind the project, the real-world applications, and the overall market sentiment. Crypto investing requires both technical savvy and a fundamental understanding of the assets we're dealing with.
So it's like choosing stocks right. You wouldn't just look at the stock price. You'd also want to understand the company's products, its leadership, and its overall financial health.
Exactly. It's about evaluating the long-term viability and potential for growth. Is there a strong team behind the project? Is there real-world demand for its application? Is the technology innovative and scalable? These are all critical questions to ask.
And I'm guessing negative news or a lack of development progress can be major red flags. We've seen how quickly things can change in the crypto space.
Absolutely. Remember the Terra USD crash. It serves as a stark reminder of what can happen when a project loses trust and its underlying technology fails to deliver on its promises. While we won't delve into the specifics of that event, it highlights the importance of due diligence and staying informed about potential risks.
Our sources actually use Bitcoin, Ethereum, and XRP as examples when talking about real-world application and long-term potential. I'm curious, what are your thoughts on those three in particular?
It's fascinating to compare and contrast those three. Bitcoin, as we know, was initially designed as a decentralized payment system. It's often called digital gold due to its limited supply and potential as a store of value. Ethereum, on the other hand, goes beyond just being a cryptocurrency. It's a platform for building decentralized applications. Think smart contracts, NFTs, and all sorts of innovative projects.
So while Bitcoin relies heavily on its scarcity and store of value narrative, Ethereum's value is tied to its broader utility and the ecosystem built on top of it. Does that make Ethereum a safer bet in the long run?
It's not necessarily about safer, but rather about understanding their differing value propositions. Then you have XRP, which focuses on facilitating cross-border payments for financial institutions. It's targeting a specific use case within the traditional financial system.
So each project has its own unique strengths and potential risks. It sounds like diversification is key here, just like with any investment portfolio.
Diversification is always a smart approach, especially in a market as volatile as crypto. It helps to mitigate risk and potentially increase your chances of success.
Okay, so we've talked about the 500-day strategy. We've explored a bunch of technical indicators, and we've emphasized the importance of fundamental analysis. It feels like there's a bit of a tension between the hodling mentality, believing in the long-term future of a project, and this more strategic approach of buying and selling based on specific events and indicators. How do you reconcile those two approaches?
That's a question many investors grapple with. It's about finding a balance between potential gains and risk mitigation. Understanding your own risk tolerance, having a clear investment strategy, and doing your due diligence are crucial steps in navigating that tension.
It's so easy to get caught up in the excitement, especially when you see prices soaring. I remember back in, well, I won't bore you with my personal crypto adventures.
Yeah.
But I think it's important to acknowledge that emotional side of investing, FOMO, the fear of missing out, can be a powerful force.
It absolutely can, and that's why it's so important to approach crypto investing with caution. Do your research, have a plan, and never invest more than you can afford to lose.
That's great advice. So to bring it all back to our main topic, thinking about the 2024 halving and this 500-day strategy, what would your approach be?
Well, if I were considering the strategy, I'd be keeping a close eye on a combination of indicators, the RSI Pi cycle and maybe even the Ichimoku cloud, just to get a sense of potential overbought conditions and trend reversals. But I'd also be digging deep into the fundamentals of the projects I'm considering.
So you're saying it's not just about timing the market, but also about choosing projects that have solid long-term potential, those underlying fundamentals we were talking about.
Exactly. It's about asking those crucial questions. Does this project have a strong team with a clear vision? Is the technology truly innovative? And is it solving a real problem? Is there evidence of growing adoption and a vibrant community around it? These factors are just as important, if not more so, than any technical indicator.
Because ultimately, those are the things that determine whether a project will survive and thrive beyond the hype cycles. It's like separating the signal from the noise.
Precisely. We're equipping you with the knowledge and the framework to think critically about these strategies, to do your own research, and to make informed decisions.
It's like we've given you a map and a compass, but the journey is yours to take. And that journey starts with asking yourself, what's your goal? What are you trying to achieve with your crypto investments? Are you in it for the long haul? Are you looking for quick gains? Defining your goals will help you determine which strategies and projects align with your vision.
And remember, this is a constantly evolving space. What works today might not work tomorrow. So stay curious, stay informed, and never stop learning.
Well said. This has been a roller coaster of insights, from the potential of the 500-day strategy to the importance of combining multiple indicators, and of course, never forgetting those fundamental factors that drive long-term value. We've covered a lot of ground. But remember, this is just the beginning. Now it's your turn. So as you think about the halving, what will your strategy be? Which indicators resonate with you? And what other factors will you consider before making your move? We'd love to hear your thoughts, so keep the conversation going in our online community. Until next time, keep exploring, keep learning, and stay tuned for more deep dives into fascinating topics.